everyone. Welcome back to the MHP Show podcast. You all know on the MHP Show, we talk about anything and everything that has to do with mobile home parks, operations, crazy stories, all the fun stuff with owning and operating a trailer park we talk about here on the MHP Show. So before we get started, I actually wanted to direct people to, if you go to free.parkinvestingpro.com, you'll get access to my ebook. And once you go to the next page, you can actually scroll down and actually download my free webinar that I did as well. And just from watching the webinar and getting the ebook, you'll go straight from the basic terms and definitions of mobile home and park investing, how it works, all the way up to structuring a deal and raising money for the deal. So go check that out at free.parkinvestingpro.com. So now, got a guest with us today. I've got Mr. Dylan Marma with Requity Group here. He's a mobile home park and RV operator and syndicator. He's actually local here to where I am, and so super excited to have him on. Dylan, welcome to the show.
Good to be here, Derek. And thanks for the intro. And definitely a lot of, like, as you said, a lot of fun stuff with mobile home park investing. So excited to dive in.
Yeah. Sure. So when did you start it's the Requity Group, right? I said that correctly.
Oh, nailed it.
Got it. Good. So when did you start that company?
Yeah. So we started this company in 2020. Fun time to start. Prior to that, I had a few years in the apartment industry, doing the same thing, ultimately, sponsoring with a few partners, a few different deals in the Southeast, doing multifamily syndications where we not only purchased the properties, but we also ran the in-house property management. So I learned a lot through my partners and through the experience there. And then 2020 hit. Partners and I just had different long-term visions, so we ended up going in different directions. And it was actually a week before COVID broke out. And I remember looking around and thinking, "What do I do now?" And the whole world looked like it was falling apart. And then I remember speaking with a few of my friends. I was in Tennessee at the time. A few of my friends and there were complaining about how they couldn't find 20% cash on cash anymore in mobile home communities. And I laughed at that because I said, "You guys are spoiled. If you could show me how to get a solid 10% in multifamily or apartments right now, I'd be thrilled." So as I dug in deeper, I began to realize that it wasn't quite as risky as multifamily. In my eyes, I actually believe the underlying fundamentals were stronger in some regards than traditional multi. So after really digging in, I had that kind of light bulb moment where I said, "Wow, this looks really attractive, and we need to dive in." And then, by October we had our first deal, and that started it.
Yeah. Wow. That's awesome, man. And so, it's funny. So I've interviewed, people on here, and, there's a lot of people that actually started in this industry, myself included, in 2020. And, turning lemons into lemonade. That's what entrepreneurs do. Right. And it sounds like that you were able to do that as well. So that's awesome, man. But what was that kind of made you, like, "Hey, I'm going to make this work in 2020 despite all the noise going around"?
I think I was at that point when I was on my own. I really just said, "Look, I'm not going to go work for someone else right now. I definitely, am passionate about being an entrepreneur, and I enjoy the real estate space." And I just kind of kept my options open, frankly. And I remember doing a lot of cold calling and just trying to find deals of different types just to, start the momentum. And when it came to the MH side of things, that's where I just devoted the most effort and eventually was able to break through and find something. So it was a combination of factors, but for me, I was just thinking about, okay, how do we keep this going? And, how do we start a business? And I was just hungry to get something started at that stage of my life.
Yeah. No, for sure. That's awesome. And so the multifamily stuff that you were in, do you still own that, or was that like a sale kind of thing? Did you guys sell everything?
I still am in a few hundred units of multifamily, and have personal investments as well as some investor-backed investments that we've offloaded some, but we still own some. So still participating in that, and even since moving down here to Tampa, moved down to Tampa in 2020, around the time we started the company. And we've picked up a few smaller local multifamily deals as like personal investments. So still like the multifamily space. And I just think the pricing, I haven't really aligned with the pricing as much in the last 3-4 years.
Yeah. I mean, especially down here in Tampa. I mean, part of me, when I look at some of the numbers on, the multifamily and the MH stuff down here, I'm like, man, it just seems so ridiculous. But I look at obviously the rent growth potential for the next 3, 4, 5 years, even 10 years is going to be massive just because of the fundamentals in this area. So I'd be curious to know if because sometimes I think to myself, man, should I be buying this stuff for $100,000 a pad in Tampa? Because yes, I'm not going to cash flow in year 1. Year 2, it's going to suck, but year 5 and on, it may be really good. So I battle with that every day. Do you battle with the same kind of things?
For sure. Yeah. I mean, I'm definitely more of a cash flow guy. And I think a lot of people in an industry naturally are, right? So that oftentimes leads us to secondary or tertiary markets because, you're just going to get better early yield on, but without a doubt, I mean, I'm still very bullish on MH in the right markets. I think Tampa, I struggle a little bit more with because of the coastal element to it and what's going on with Florida insurance. So at the moment, I'm a little bit more hesitant with certain areas within Florida and just thinking about the headwinds that some of these assets are going to face if they're going in at 4 caps. But the good MH and good markets is, in my opinion, the best or close to the best asset you could possibly own long term if you take a long enough time horizon, especially if it's tenant owned home or you convert to tenant owned, and if it's if it's got city utilities. I mean, it doesn't get, and it's in a state that's friendly towards landlords, right? Not overly tenant friendly. I still think it's like arguably the best type of real estate that you could possibly own over a long enough period of time. So I understand why the cap rates may be where they are because they're factoring in the future rent growth. But I think it just comes down to whose capital is going to be more patient and willing to participate with a lower yield early on. And I tend to like a little bit more opportunistic return profiles, so it makes it a little bit tougher to compete in these markets oftentimes.
Yeah. Same. And we bought a bunch of stuff in these markets in, 2021, the beginning of 2022, but it's just, trying to finding stuff that pencils now is obviously a little bit more difficult for everybody. But also too, in my personal opinion, when I first started, I was like, I don't give a shit what kind of deal it is. I'm going to do the work. It doesn't matter. I'll do this heavy, nasty value add stuff. But now, my opinion's changed a bit because is the juice worth the squeeze? Is it worth dealing with all the headaches and things that come with that? So I don't know. Right.
Yeah, we deal with the same thing. I mean, we took on a lot of really heavy lift projects and we're still actively executing on the business plans, and we will go after the heavier lift stuff. And in fact, oftentimes that's where we end up being able to find deals that pencil. But I think it's just, weighing it up, right? We're not going to go after a heavy lift deal if it's only, 30 pads or something like that and deal with the headache, right? So I think it has to have a scale to sort of justify, the brain damage that comes along with the execution on certain projects.
Yeah. There's definitely some brain damage, and even some of the value add stuff that we have, it's stabilized now, but there's still infrastructure issues that we're working through and various things. Because some, these Florida special parks, they're, the high density, older homes, they were developed in the 50s. Like the infrastructure is just, it's terrible. It's going to go out at some point. And so do you have any parks in Florida now?
We only have one. It's funny because I moved down here and chose Tampa because it was still close enough to Central Florida, which is where I felt like the most opportunity is going to be available. But it's been, our one of our smaller states in terms of where our portfolio ended up being, and just we've really kind of struggled to find deals here that we've been able to get excited about. So the majority of our portfolio is in North Carolina, followed by Tennessee, and then we have additional states beyond that. But yeah, that ended up being kind of the sweet spot for us after all.
Yeah. Where did you buy your first park?
Jacksonville, North Carolina, coast of North Carolina.
Yeah.
And that, we've really enjoyed that market. Now we have over 1,000, mainly RV, but we have MH and RV across the up and down the coast.
Yeah. I remember looking at a deal in Jacksonville, North Carolina, maybe like a year later, but I didn't really know much about the market, and it didn't seem that exciting. But obviously you found value in that market. But on the surface, I remember looking at it, it didn't seem that great.
The market looked fairly sleepy, but it's actually had some of the best rent growth in the country. But I'm not going to act like I ever would have seen that coming. So we got really lucky in that sense. And the story actually is funny, because when I initially was looking around, I was so hungry for our first MH deal. I was just like cold calling brokers. I basically was saying, I'll go after 20 units. Like, I just want to get in the game and find a good deal to get started and make sure it's done right. And so I said, I'm not going to set my size parameters at 100 plus, lots anymore. I'm just going to start going after, smaller deals just to find something to get started with. And then I started calling around, and I thought I was calling on a deal in Jacksonville, Florida, because I'd never heard of Jacksonville, North Carolina in my life. And I was just going through the list on Crexy, and I called on this small deal. It was probably, 20 something lots. And I got in touch with the broker, and he started telling me about the deal, and I go, Jacksonville, North Carolina. And then I, as I do on any, broker call, I always ask, what else do you have? Right. And he actually said, oh, well, I actually have this other deal that's, 160 lots, and I'd be happy to share it with you. And I haven't listed it yet, blah, blah, blah. And I said, that would be fantastic. Send it over. And then, it ended up being just a, tremendous deal. And we've been super blessed with the way that one's worked out so far. But it just goes to show, right? You really can't connect all the dots looking forward, right? It just was a random moment, a random phone call that led to us being able to kind of get in the game and sink our first opportunity.
Yeah. And that was in 2020?
Yeah.
Got it. So when did you close on those parks in 2020?
First one was October.
And then how many pads do you have now total?
We're over 2,000 total pads. I don't know the exact count, but over 2,000, and it's spread across 17 MHRV properties.
Wow. That's awesome. And it all started from that one park. So when you got into that park, I'm assuming you hired managers. Did you do any of the operations yourself? Because that was as enough scale that you probably may have not had to.
Oh yeah, no. Thankfully, I've not had to be the manager on anything we own, but we do all the management in-house, and we have 60 plus employees now scattered throughout, mainly with our on-site teams. So we've definitely built a strong operations team from day one. But we had a community manager on site and a full-time maintenance crew on site, being that we had a lot of park-owned homes. And for me, that's where I found all the value when I first got in, because there was so much stigma around park-owned homes that no one wanted them. And everyone was like, I want the tenant-owned home deals. And I'm coming in with the apartment mindset of being used to working with maintenance teams and, knowing the general economics on what it takes to turn a unit and to get it ready for sales. So the majority of our MH deals that we bought, almost all of them in the beginning, were heavy POH deals, because at that time, no one wanted them. A few years later, everyone's starting to get desperate for a deal. And then they started to get, pricing started to, I think cap rates came down a little bit on those, but there was, I think we hit a nice little blip where for about 12, 18 months, we had a nice buying spree where we were one of the only groups that wanted the park-owned home deals. And, our business plan is generally to go in and then sell off the homes over time through rent to own or cash sales and third-party financing strategies. So that really helped us get our start.
Yeah. And like in the beginning, I'm sure you thought going in there, because that the park you bought in Jacksonville, that was a park-owned home park.
Yeah, heavy. It was 130 or so, 140 at 160 were park owned. It was completely heavy park owned.
Yeah, because I'm sure like that's probably one of those markets where like the lot rents, $300 or something, but you can get 1,200 for a park owned home. Is it a market like that?
It was like that at first. Yeah. I mean,
Yeah.
the rents have definitely gone up there since getting started, but yeah, it was similar to that where the POH rent was nearly 3x the market rent, and these were nice homes. So I can tell you, we've experienced the older homes and the newer homes, and I think the majority of these were 2000 or newer. And it's a totally different experience. Like you're actually able to make a profit on the homes themselves, and run a pretty decent business, without the ongoing capex. But we've also experienced the flip side of it, where you're dealing with a lot of 80s and 90s homes, and when you start to really factor in the ongoing capital needs of them, it really is a tough business model, and it's extremely capital intensive. So we've generally formed the philosophy of, for the stuff that's pre 2000s, we have a little bit more urgency in helping, sell off the homes versus the newer product. We kind of take our time, and we try to, really get a decent price for the homes, and still extract some good value.
Yeah. When we got into this and we were buying the park owned home stuff, like we didn't even factor any home sales costs into it. And so we realized when we bought the first couple Tampa deals that we were able to, in that market, we were able to sell those homes for we didn't expect anything, $5, $10, $15,000, and sometimes more. And these were older homes too. It was
Tampa,
surprising.
you see crazy sales. Yeah, in Tampa, you see old homes sell for 80 grand here. Like it's not uncommon. So it's impressive.
Yeah, we had a guy come in on one of our parks on Nebraska Avenue. You probably know it. He came in and rehabbed this. I was a 70s mobile home, and he sold it to somebody for $60,000 cash. Like
that's insane. Yeah.
Yeah.
Definitely doesn't happen in a lot of other markets.
No, it does not at all.
Are you guys mostly in Florida?
Yeah, mostly in Florida, and we have some ownership and stuff in the Carolinas as well.
Okay, nice.
Yeah. You were mentioning something how you guys run the operations. Did it take you a long time to when you got into this business? I mean, you were in multifamily, but to realize that, okay, hey, this isn't totally a passive investment as it was being preached back in the day. Like the operations is tough and you have to know what you're doing.
Yeah. So I think because we got into a lot of POH stuff, it's a totally different business than if you're just buying TOH, tenant owned, or the resident owns the home directly. I think in the park owned side of things, it's a very different business model, and it's a lot more active than if the residents already own their own homes. So I would say I was pretty prepared for it. Nothing really caught me off guard in that sense. Probably the biggest thing I had to really develop a thorough understanding was private utilities, because coming from the apartment background, you don't deal with them. The most you deal with is older buildings that you need to scope the lines. But I didn't know what a leach field was. I don't think when I initially started, right? So I did not know virtually anything about septic systems or treatment plants, and now I've certainly gained an appreciation for the different private utility systems out there, and we have been able to better form our opinion on the various risks and the challenges that you can have with different private utility systems. So that's probably the biggest area that I wasn't familiar with, that had like the most learning curve. So that was where a lot of the time went.
Yeah. That's do you guys own private utilities now?
We have quite a bit. Yeah, we have I'm totally ballparking here, but like half the portfolio is probably private utilities. We have 2 different treatment plants, and we have quite a few septic, mostly septic. We have a ton of septic, but frankly, septic doesn't really scare me that much, knock on wood. I mean, we've had some issues, and we're in the process of replacing 2 large tanks right now. And we've definitely had our headaches, don't get me wrong. But I think when I see septic, especially if there's a good ratio, if it's like 1 home per septic tank, then no problem, as long as, these aren't super old tanks and they're, built in the last, ideally, like, 40 years, 30, 40 years, that's always ideal. But as long as there's a good ratio of tanks to homes and we have adequate replacement land, I'm generally okay. I'm generally able to get comfortable with a lot of the septic systems out there. Just making sure we do a thorough diligence up front on those.
Yeah, I agree with you. And I'm fine with septic too, as long as I can get bailed out if necessary.
Mm-hmm.
By they're tying in and it's close. I don't have to, like we're having to do over here. We've got a directional bore under the main road, which is, another $150,000, $200,000 to do that. But as long as my out is okay, or if I can replace tanks, like in this particular park, we can't even replace tanks. And we can't replace the well either, because it was developed in the 50s and the setbacks are all jacked up now because there's a railroad behind the park. So you can't even drill a new well, and there's septics under the houses, and like it's a mess.
Yeah. I think that the older ones are where you have to be most weary, right? And that's a lot of the Florida landscape, right? As you get these places that were built in the 50s, and we deal with some of that too, though, where you have you're not in compliance with the current setback ordinances, and you got sites on top of tanks and things like that, and that definitely can get messy. So I'm definitely not saying just go ahead and a septic tank. I'm definitely saying there's a very thorough level of diligence that needs to go in, but assuming you can get past that and it checks out, what you're looking for, then I'm comfortable with them.
Yeah. I mean, if you want to scale in this business at all, like it's just, these deals are never perfect. Like they're not, and you're going to have to, like, it would be ideal to get all public utilities, but how likely is that?
Well, you have to think about the why behind it, right? There's a reason that there's not an apartment building sitting here and you have a mobile home community or an RV campground there. It's because it wasn't you can't build an apartment building on private utilities. So the reason behind it is simply the fact that, this is a good product type for private utility asset type. And that's why these end up getting built in these locations, right? So I think it just comes with the territory.
Yeah, for sure. So you're doing MH and RV. Like, what's the percentage of split between your portfolio?
Right now, we're a little bit more skewed towards RV, but we have some pipeline lined up that will hopefully put us around a 50-50. So we have a pretty even blend, MH and RV, and we look at a ton of deals each week, and we kind of right down the middle. But over the last year, maybe the last 18 months, we've been much busier with RV, just given we really had a tough time making sense of anything in the MH. I mean, we were 30% off every, listed deal we could get our hands on. We haven't done an MH deal on the market, but it's all been off market. But we were just so far off from pricing that we struggled for a little bit of a dry spell there. But I'm hopeful that now with the rate increases really starting to set in, I think we're starting to see some deals that are penciling at a level we can get excited about again.
Yeah. That's been the trouble with me. Like, there's just I have to get excited about a deal, because if I'm going to call, Joe over here and ask him for, $500,000 or something, I got to be excited about it.
Oh yeah.
Like I put my money into the deals as well. So like, I'm not just doing a deal to do a deal. And like, I just haven't seen much that's that exciting lately.
Yeah, exactly. I mean, I think we set the expectations early on. Everything we were doing was paying out, 8% from year one, maybe year two, right? But it, I think, or greater in some cases. So I think, when you're looking at deals that, when you really pencil in the full expense load are not hitting 8% for the first few years, then it's tricky, right? I think I generally lean towards more cash flow, and I think more cash flow provides higher probability of a substantial capital event like a refinance, a few years in. And, I think naturally, I think a lot of our investor base has similar appetite as that's who we've attracted over time. So there's just so many deals I look at, and if I can't get excited about the yield, then definitely can't. I definitely have no interest in sharing that with our investors, right? So
yeah, no, and you like doing the work, because it's going to be a lot of work. There's going to be stuff that happens, stuff you got to deal with. And like,
yeah, what happens when you have a setback or something goes wrong, and you have such low yield, right? It's kind of your margin of safety. So
yeah, and that's where I've started. So we own some RV like sprinkled around the portfolio, but no 100% RV. We're probably 98% MH. And I've been looking at some RV deals, but like even yes, the cap rates are higher, but there's less margin for error still in some of the markets that I want to buy in. And I've never really operated an RV park before. And so I get sort of apprehensive, if I don't get excited about the deal. And obviously, if, there's stuff that's going to come up that I didn't expect or I didn't know about.
Yep.
And so that kind of makes me a little more apprehensive to doing it too. You can't plan for most of the stuff that happens.
Yeah. Yeah, RV is a different beast. I mean, there's definitely a lot of nuances to it that you have to be familiar with. To me, on the onset, it is more dangerous than MH if you don't know what you're doing and you get into a deal. I think the area where most people can go wrong the fastest is by not knowing their expense load and by radically underestimating the expenses that these take, or looking at it thinking it's the same as an MH deal. Because it's very different. Your payroll is substantially more, your expense load, your marketing budget is substantially more. You have events involved, you have additional, Google and Facebook ads, marketing costs. You have, a lot of different variables that go into the expense load. So I think that's the number one way you get hurt, is by underestimating your expenses. So it's extremely important to have a thorough understanding on what your true expense load should be. Because, at a minimum, they're usually twice the expenses per site per year as an MH. And when, you look at RV, the other piece you have to think about is truly thinking about it from the operational side of things, because it is more of a business, and you do have more turnover, call it. We have mostly seasonal RVs, so most of our people are there for long term, and we have annual site agreements in place, but you still have a transient piece to it, and there's still more in and out. So you have to know what you're getting into. And I would also recommend that, unless you're planning on making this a lifestyle and living on your campground, that you make sure you go for something with adequate enough scale. Because if you go for something too small, the unit economics just don't work, and you're gonna have a really tough time. So there's a reason that the institutions mainly look at 200 plus site RV campgrounds, and it's not just because they need to write bigger checks. So that is a piece of it. It's really because the unit economics are much better on bigger campgrounds than on the smaller ones. So I think you have to really think through the nuanced aspects of operations, as it certainly is more of an operating business than that.
Yeah, so that's interesting. When you mentioned that, as far as the institutions going after 200 plus RV parks, and that's I just need to do more. I'll probably need to ask you some questions on RV parks too, because I am interested in the space. The transient. So you guys have some that are basically like fully transient, like come and go parks, 100%.
We do. But I'll preface that and say that even those we try to gradually convert to having a longer term base. I'm not saying we're going to do 100% conversion, but we're probably more welcoming than some of the more serious transient groups are to having a higher percentage of monthlies or annual site agreements in place. Especially in this economy, I prefer to have the stability and the durability of the income stream that comes from having, a pretty solid portion of long-term guests.
Yeah, for sure. And so you'll basically come in, let's just say you buy a park, it's 75%, nightly or weekly or whatever, and you'll gradually convert those over to monthly. Like when they move out, you'll put an ad out for like long-term RV sites, monthly, 6 months, a year. Is that how that works?
Yeah, I mean, we have one I'm thinking of that was pure transient acquisition, and 2 years later we're 70% long term. So we definitely have made some good strides on converting to a more long term base, and we always underwrite the deals as if they're all long term, just because we're trying to stress test to see if we had to fill it at an affordable enough rate with a long term, does it work? And then any transient or income that comes in based on the transient model is usually additional upside opportunity, and it helps kind of fill in the gap while you're getting stabilized.
Got it. And you'll basically, when you say long term, is that like, what do you mean by that? Is that considered a month?
That's another area you can get hurt in this business if you don't do your diligence. I've seen people go in and assume like crazy high occupancy rates, and they use the monthly rate listed on the website as their rate for having high occupancy. There's usually about a 30% delta between the annual rate and the month-to-month rate. And month-to-month people usually do not, they're usually only going to be there for a handful of months. So they're not going to operate those sites at the same occupancy percentage as you will on a true seasonal campground. And I define seasonal as generally having an annual site agreement in place where they're in somewhat of a lease or a site agreement that, is a contractual obligation to, be a guest for the campground over the 12-month period, rather than being on a month-to-month. So month-to-month, just like anything else, right? If you have a shorter lease, you're going to be paying more of a premium. So the month-to-month gets more flexibility. And it's great for like contract workers or traveling nurses that aren't really sure on what their time horizon is going to be, that they're going to be there. And maybe they get, they get compensated by their employer for their stay, but the annuals are more attractive. Frankly, a lot of the annuals we have are more like second home sites where they're there for the purpose of being a member of the community and coming there on the weekends and raising their kids there, bringing them there over the summer, being a part of the events. And that's why they are popular on major bodies of water. But yeah, I think the seasonal sites are a lot more sticky revenue, but you can't go in assuming you're going to get the month-to-month rate on a 12-month site agreement, because it's probably going to end up being 30% less per month when you start to break it down.
Yeah, that's interesting, and I could see where guys could go wrong with that, because that makes a lot of sense. Someone signing a year lease, you're going to get a better rate versus the guy who's signing a month, obviously week, day, or night. It's interesting.
Yeah,
and it's you probably, so if you're at 100 site MH park, you probably got one manager that manages that one, or maybe that one plus a couple of others. In a 100 site RV park, are you going to have like a manager and an assistant manager?
Yeah. So it really varies pretty drastically based on the way the makeup of the guest profile. If you have a lot of seasonals, then chances are you may have a little bit of a lower payroll than if you have, very transient, because in the transient places, the stores, the on-site stores are way busier, and you have way more check-ins and checkouts. So having adequate size front desk staff is crucial to being able to make sure that you're able to service the in and out people. So that's why transient, yes, it should do more revenue, but the NOI is sometimes offset because you have a bigger expense load as a result of that. So typically on 100 sites, I think you would run 100 sites with one on-site manager, probably part-time or a seasonal support staff that can help them. This is just on average, broad strokes. It's a mix of transient and long-term, and then at least one full-time maintenance and maybe maintenance support depending on the needs of the place. So it definitely, as you can see, it's just a much bigger staff required. And remember the landscaping, on a lot of different mobile home communities, the residents actually do their own landscaping, whereas virtually every campground that we've seen is always, it's the responsibility of the owner, and people appreciate the attention to detail and high-end landscaping. So that's a big piece of your expense load, is making sure you have either in-house maintenance or landscaping that's contracted out, and that adds pretty sizable amount to your total expense load.
Yeah, because landscaping has gotten expensive in the last 2 years, like even more. It's crazy.
Yeah, the big three differences when it comes to your expense load is utilities, because this isn't all master metered, direct billed to the resident. This is now a master meter for that goes directly to the ownership. And on longer term stays or month to month, you can bill back electric, but you have to remember that all the electric is still going through you. And the same thing for water and sewer. And that's usually not billed back. I haven't seen it being billed back yet. But your utilities are substantially higher because you're paying the whole utility bill. And then maybe you're doing some bill back for your electric to offset it, but it's not as substantial as direct billed would be. And then you have payroll, where you have a bigger sort of front desk staff / campground host that's there to ensure the experience is right. Your marketing budget is higher, because you have ad spend and you have event spend. So those are really the three big areas where you have a pretty wide variance versus when you try to compare the two.
Yeah, that's interesting. You have like an event planner there that puts on whatever for holidays.
Yeah, we have a lot of events. We have event schedules at every one of the campgrounds, and they map them out. Like I think right now we just finished our 2024 event schedule, and we try to promote them through the Facebook pages, through the different channels. We have them on our website, and some events we try to even boost with some paid advertising.
Yeah, that's interesting. Is there because to me, when I look at, I'm so used to doing MH, it's like simple underwriting. I can calculate it on my phone in 2 seconds.
Yep.
Like when you're those kind of parks that have, you got to plan the events for the year like that. It doesn't seem, and just thinking out loud here, that that's something that you can just back of the napkin underwrite. Maybe you can, unless you know it like the back of your hand. I don't know. Can you do that?
I would say I can usually tell if a price is ridiculous pretty quick now. I can usually back of the napkin have a general idea as to what our ballpark expenses per site generally are, and I can tell if a broker is just way undershooting, or if the asking price is just nowhere near where I would hope it would be. But so I can usually screen out the outliers pretty quickly. But when it comes to actually being able to come up with our final offer price, it definitely is more work, because you really have to, and even due diligence, you're spending a lot more time really understanding who's there, what are they about, what are they into, where are they coming from, how do we really fit the guest experience that we're here to provide to cater to the audience that we're working with, because everyone is a bit different.
Yeah, no, it's interesting. That's, it's a fascinating, business model to me. And I I'm highly interested in it. I just haven't bought one yet, but obviously it's a definite switch from MH. It's more clearly there's more operations involved. It's more it's a resort. It's a resort.
And I've seen some people that have gotten in and just not liked it and, got out of the space. And then I've seen some that love it and, are doubling down and making this their primary focus. Right. So it's definitely not for everyone. And I think, you have to sort of have a general vision of, is this something you're going to do or you anticipate doing, multiple times over again? And, sort of forming your vision as to if it's worth it. Right. Because I think for us, being a multi-campground owner, we've started to really develop a whole platform around how we operate these. And, we have sort of our kind of SOPs set up in a way where, we feel like it gets easier each one that we do. But it'd be a lot of work to do it on just one, unless that was our sole business or something along those lines. But, definitely is a different experience. But I think it's still, it's still a great business, higher cash flow potential than most other deal types in the market, right? I mean, we're generally targeting double-digit yields, and the depreciation benefits are substantial, very similar to MH in the sense of great depreciation available, very low I would say lower CapEx. And here's the cool part one of the things that actually stands out about the business is that you have a kind of bucket CapEx into two buckets. You either have your bucket of this needs to be done and it's not going to make the place any better or make you any additional income, or this could be done and this is going to boost your income over time, right? You have your sort of like needed deferred maintenance CapEx or your improvement level CapEx. And campgrounds are one of the cool businesses in the sense that you don't have a ton of the always has to be done deferred maintenance CapEx. If you compare it to, C-class apartments or something like that, it's still fairly low CapEx or lower CapEx than like park owned home, mobile home communities, right? But the when you look at the opportunities for improvements, it's sometimes endless. I mean, it depends on the market you're in, and you don't want to overdo it. But if you think about the premium you can get, hey, if we spend, $6,000 upgrading the site to concrete, we can get a 3-year payback on that, improvement done, right? Or if we add a little barbecue set next to the sites, then we can charge, $20 more per night. Or if we add these amenities, then we think our overall occupancy or, our average daily rate is going to be able to increase over time. So there's quite a bit you can do when it comes to your, generating upside through the capital improvements. And then in addition to that, I think one of the most exciting opportunities about RV campgrounds is the potential to do expansion plays. And that's what a lot of the serious operators look for, is the campgrounds that are already zoned. So you don't have to go through all of the, planning and zoning difficulties of getting the initial infrastructure set up, but there's extra land. And then, it depends on if you're doing it in-house and contracting it out, but, say $30,000 a site, if you can build for $30,000 a site in an area that's worth $60,000 a site when you're done, I mean, that's an amazing return on your capital. So I think expansion plays are some of the best opportunities in the RV space for those that know how to do it. Whereas like MH, it's not quite the same, because even if you could build a site for 30,000, which you might be able to, but you're going to probably lose, in most markets, you're probably going to lose money on the infill. You're going to lose 15 grand or 20 grand just getting, dealing with the setup costs and the carry costs while you're trying to sell off a new home. So it's way more capital intensive, and generally ends up being a lot more expensive and doesn't always pencil on MH.
Yeah, I agree, because I'll see deals. I'll get sent the deal by a broker, and they're like, "Oh, expansion opportunity," and they still want 30 grand a site for it.
Yeah,
and I'm like, well, after I bring in the home, if I bring in a new home, and like you said, the transport costs, I'm over 100,000 a pat. If I bring in a new home,
it's crazy. Yeah,
it just doesn't work.
Yeah, I was going to say that's the one thing. And when it comes to the mobile home space, we really haven't been big on infill. I know some people love it and they do great at it, but maybe I just got in too late. But I feel like by the time I entered the space, most deals, they wanted full price for their vacant lots. And then we also had, with COVID really accelerating all these supply chain issues, like pricing went through the roof, and there's uncertainty on when is the home going to come in, how much is it going to cost. And then we've had plenty of challenges. I mean, we've done infills, but we still have plenty of challenges finding the right installers and dealing with all the cost of install, HVAC costs doubling. I mean, there's been so many variables thrown in the mix there, where to me they're actually some of the least attractive value add opportunities out there, unless you're in just a phenomenal market. But a lot of those are already bought up, or people are paying crazy prices for them. So I'm not very bullish on infill projects at this point in time. Maybe it'll change, but
Yeah, I couldn't agree more. And we've never done heavy infill projects just because of that. Now, if we had an infill project in Tampa or Orlando, it would work. I mean, the numbers and the economics would actually work, because you would have people that come in and they would literally write you a check for some of these houses, But, on the other side of that, I mean, there's just so much, it's just a lot of capital out front. For one, and then all the other issues, even like you said, AC costs have gone through the roof. And like, we moved a home in over here a few months ago, and shitty mover, they ruined the plumbing under the house, so it was like an extra $10,000 that we didn't even expect to move in the home. So just little stuff like that you know finding a good mover in Florida is very difficult because the good ones are all so busy. You can't even get on their schedule. It's not an easy value add play at all.
No. Yeah. I would be very conservative if I'm even an limited partner investor or like an active, investor and anything with Infill. I would definitely budget really healthy timelines and make sure, we're okay with some delays. You kind of have a buffer there. And it still looks good after that.
Yeah. Yeah. I wanted to move and ask you a little bit. So how long you've been syndicating deals for how long now?
About 6 years.
6 years. Got it. So, I hear people, they talk to me, they want to get in the space, they want to start syndicating deals. And I'm like, well, yeah, you can do that, but it's not that easy. There's things you have to do. Like, what would you tell someone that, wants to start syndicating at some point? Like, what are some things they need to know or some tips that you could give them?
I think first off, you have to make sure it's for you. Like this isn't like an easy, like you shouldn't be doing it because you just love like the profits or, like you can't be looking at like a cash grab because it's a ton of work and it's really like a ton of responsibility. Right. I mean, when you have hard-earned money of your investors on the line, you need to be going in it with the approach of you're being a steward of their capital and you're ready to do whatever it takes and run through walls to make sure that you're maximizing the return and executing on the business plan that you set out on. I think it's much easier to just do a deal with your own money and, you be the only person at fault if things go sideways. But when you have to go and report and face investors and you just have you have expectations, you have responsibility. So I mean, for me, it's almost become somewhat of like a lifestyle where every day I'm waking up and thinking, how do I maximize the return on our investors' capital? And it's become a big part of my life in that sense, right? So I think if you're looking for passive income, then you shouldn't be raising other people's money. I think if you're looking to reap the rewards of the exponential returns possible for performing, and two, to be kind of getting general fulfillment out of working with other people and having limited partners in the process that you can kind of champion for, then I think it makes sense. So the first thing I would do is like seriously question, is this something I really want to do and I'm committed to doing, and making sure you are fully committed to the plan and you like the general idea when you're going in, and then once you've decided, okay, I do feel like I'm in a position where I'm comfortable taking on, the responsibility. Then from there, I think start small is probably a good idea, right? Always either like partner with someone that has more experience, maybe, and help because you're de-risking your investors in that process. If you can partner with someone that's got more experience, even if you have a small piece of the pie, just focusing more on your track record and thinking about how can I de-risk my investors as much as possible and, still get the hands-on experience at the same time. I think that makes sense. And then if you are doing it all on your own and not partnering, then maybe stress testing the deal with people that are experienced and, just making sure you feel like it's a home run deal when you're getting started. And, because in the beginning, it's all about building up a track record. And then, always make sure you're doing everything compliant, right? There's the SEC attorneys. You have to make sure you're getting the doc structured the right way. You have to, when it comes to more of a tactical advice, if you're saying, okay, I'm fully committed to doing this now, like, how do I start to have these conversations and build my investor base? My tactical advice would be more relating to starting the capital raise happens way before the deal comes live. It's not which one comes first, the deal or the money. You should be planting seeds, letting people know your intentions, letting people know what you're doing way in advance, and maybe even sending like email updates and building like a list of people that you can kind of keep engaged and say, hey, I looked at, 4 deals or 40 deals this quarter or whatever. Right. And here's my general findings in the market. And this is how my viewpoints are changing over this period of time. And, and we'll keep you guys posted when we finally find one that seems to meet our buy box. And then, eventually when the deal comes up, now you got, 50 people or 100 people engaged that you've been talking to over time and planting seeds with. And then that's why, the raise itself usually happens in like a day or, maybe a week or so, like, because you've planted all the seeds ahead of time and you've already got the buy-in. And now, you're presenting a deal that meets the expectations that you've already set. And hopefully a lot of the work has already been done for you before the deal came live.
Yeah, for sure. And that's freaking awesome gold right there for our listeners, because I think that's crucial, because one, you have to commit to doing this. You got to be like, this is what I'm going to do. I'm willing to take on the responsibility. I want to raise outside capital. Then you have to start first, make that commitment, like you said, and then start doing it now, because you don't want to get a deal under contract and have no, communication lines with anybody. Like you don't have anybody. So it's going to be a stressful down to the wire kind of thing. And I think that's great advice, what you said, of keeping people updated, even if you don't have any deals going on right now. I think that's great. And I mean, me personally, because I haven't seen that like investor capital is scarce. I have many people that are eager and hungry to get into deals. It's just, I think deals are a little bit harder to come by now than anything else.
Yeah, I would generally agree. But I remember in the beginning, that was the big hurdle, right? Mentally, I was like, well, how do you bring on capital and this and that? And I think the investors are out there, but you have to definitely kind of make it known what you're doing and brand yourself over a period of time. And then the number one way to attract investors is to actually do deals and perform on those deals and do what you said you're going to do, right? The other piece out a recommendation I have, when it comes to capital raising is really don't look at it like a sales job, right? And I think there's oftentimes people compare it to how good you are at sales, but I think that the more sophisticated investors and the people that are usually going to be your better repeat investors, like I think being as transparent as possible and as honest as possible is really what builds that trust that you need to develop the relationship that you want over time. So you almost want to present the risks and the things that could go wrong as just as much and just forthright as you do the opportunity that's at play. And I think really getting into like the risks and mitigants and being able to explain them shows them that, this isn't just someone that's just like, everything's going to be perfect, everything's going to be gravy. And I think setting like very realistic expectations, really diligently thinking through your pro forma. Don't overshoot on your pro forma and just to try to get someone to buy in, because that's going to be a very short-lived relationship if that's what you do. So being very practical, very diligent with setting the right expectations on your pro forma. And then when it comes time to, having discussions with investors, it's a lot more, I've tend to find that, to build like the long-standing relationships, it comes from like being willing to show them the warts and, just being very transparent as to, the process and, why you think the opportunity is worth it and that kind of thing. So I see a lot of people that just oversell like online or, just from like the limited interactions that I've had to just act like everything is golden and this is the best thing ever and nothing could go wrong. And I feel like that's just the wrong approach.
Yeah, I agree. And I actually had an interview with a guy who's a very large fund manager in this business. And he mentioned when he talks to investors, he's pointing out the risks and he like oversells them on the risk when he's talking to an investor. He almost doesn't even talk about the upside of the deal, the IRR, the cash flow, nothing. He's talking about, the fundamentals of the asset class, why he likes this particular asset, and then mostly about the risks of the deal. So I think that's vital information, because when I talk to, high net worth individuals, they don't like to bullshit around. They want, like, they've done deals before, they know shit can go wrong, and they want to know what can go wrong. And I found that.
Yeah, and if you're not willing to tell them up front when the deal's going live, then what are their expectations? If you're sugarcoating everything on the way in, they're just going to expect you're going to sugarcoat everything the entire life cycle of the deal, right? Versus actually telling them what's going on, right? And I think that level of transparency is super important. I'm a big fan of Warren Buffett, and read like a lot of his newsletters and annual investor newsletters, and I think he's a great role model in that sense of when you read his stuff, he talks about all the mistakes he's made and, all the areas he's got wrong over time, and very critical on his own, thought process. So I feel like trying to absorb some of that and go in with that same mindset goes a long way.
Yeah, for sure. Because you don't want to, and I think that's great that you talked about it not being a sales game, because I see people say that it is a sales game, and I guess it kind of is to a degree, but relationship building and being transparent. I think
that's a good way to put it. I mean, it's a sales game in the sense of like some sales are transactional sales and some are more like relationship based sales. So just make sure you're like looking at it from the eyes of, we're looking for like long-term relationships, because you're going to be tied together for 5+ years once the deal's live. So you have to make sure you go in and set the right expectations. And I think that's what builds the right level of trust.
Yeah, for sure. Are you guys buying and holding are you guys exit in 5 usually, or?
No, most of our portfolio has been purchased with somewhat indefinite timeline, with more of the expectation to go in and refi and then continue to hold. But that doesn't mean selling's off the table. It just, we're really just going to do what we determine is best as we approach, the 5-year mark.
Yeah, for sure. What do you see in like the future of, I guess you combine it with MH and RV, like what do you see, 10 years down the road? Do you think there will ever be a market disruptor that kind of shakes up the market a little bit, like 3D housing, 3D printed houses, or anything like that?
Yeah, I don't really have a great answer to that, because who knows? I went down a rabbit hole on 3D houses a few years ago, thinking, maybe we could get into building those. But as I got into the actual cost, it didn't really seem like there was enough margin there to really justify it over, traditional MH. But I think something could absolutely happen, and there could be something that disrupts it. But I think the MH is so attractive because of the supply aspect of things. I mean, it really is what makes it one of the most attractive investments out there, because the economics don't generally work in most markets to build more, and people are only going to need more and more affordable housing. I mean, if you see just where the economy's going, and not even in the short term, but I mean, if you think about AI and all the potential disruptors that could happen to the job market, I mean, the future probably is going to still have a very strong need for affordable housing. And this is one of the most affordable types of housing. So I think that, to me, has that's where a lot of my conviction comes from on the long-term prospects. And on the RV side, I think I like to always view it from, you sort of want to view every deal from like a rosy lens, and then view it from like a very cynical downside lens, right? And that's why I think for us, we've always tried to stress test every deal, looking at it with more of a long-term tenant base, because I do think that, while most of our campgrounds cater to more of a recreational audience, I think that having the potential to convert or to start to move more in the direction of having affordable housing options always sort of helps me sleep at night a little bit, so that if consumer appetites change, we still have the potential for the campground to service, a base of people that are looking for affordable housing options. Because I think, just like MH, I think that is certainly one. And we're seeing with the, with Starlink and some of the innovations that have taken place to help make Wi-Fi more accessible, more of the work from home jobs. I think that there's a bigger segment of the population that will continue to live full-time in their RV. And I think that gives me comfort and the long-term prospects there as well.
Yeah, for sure. And that's great insight, man. And I worry sometimes because, the fundamentals of these assets are great with the affordable housing and everything that you just mentioned. But like I've looked back at times in history when, people thought X, Y, and Z was never going to change, like it was going to be great forever. And then there's
Like
some
office space
disruptor.
right now. Yeah.
Yeah, exactly. Like if you would have told someone in 2002 that office was going to be, freaking in the turmoil that it's in right now, people have been like, dude, you're freaking crazy, dude. There's always going to be businesses, always going to be people working in offices, blah, blah, blah. And so I don't know if it's going to be from like a regulatory policy perspective. I could see something coming down nationally for affordable housing or mobile home parks or something in general that could kind of disrupt the industry. But I just, I'm always just a little cautious about that. I'm very bullish on the industry, but I know that, I just never know what these crazy people in Congress are going to do or come up with.
The regulatory stuff scares me more for sure. The regulatory, especially on MH, I think we've seen some just situations where, one guy built a community, 40 years ago. I just recently had an interaction like this where, a guy built it. It was his life's work. And, if it weren't for state regulations, he probably was going to be able to sell it for maybe $8 million. And, now he's having a hard time getting out at even half of that, and even covering his mortgage payment might be difficult at the price it's probably worth right now due to restrictions from the state where they're limiting him on how much rent he can charge, in addition to forcing his hand on upgrading to city utilities and paying for it himself and some of the other things that they can mandate. So I think being selective over the states that you invest into is crucial now more than ever, because it generally seems like it happens on like a state by state level. But I do worry about that even at a national level at some point. So I think that's one of the bigger possible threats that we face, in my opinion.
Yeah, for sure. I agree. Well, Dylan, dude, I do. This has been great, man. I love chatting with you. I could keep going here with you, but we're running out of time here. Is there anything like that you wanted to leave for our listeners? Any tips, life advice, any little golden nuggets you want to leave them with?
Let's think. So, I think the biggest thing that I would say if you're looking at MH or RV is just do your homework and really determine what sort of role fits you best. I think a lot of people like the idea of being active, but for a lot of people I know that have gotten into the space and done their homework, they've determined that they like being on the passive side better. But I think you do a good job at through your social media and different things you put out there of kind of showing people some of the dirt that comes with it and making sure, everyone's clear on, what it looks like behind the scenes, but definitely neither one is passive. When you look at being the operator yourself and, definitely just wish everyone the best of luck.
Awesome. Well, thanks, Dylan. And where can people find you?
You can find me on LinkedIn. That's LinkedIn and also X. Those are probably the two platforms that I'm most active on. And you can always reach out to our website, therequitygroup.com as well.
Yeah, and I will say this before we go on Twitter, X or Twitter.
It's so hard. I think it's the first time I called it X publicly. So
I because you said that, and I'm like, shit. The other day I was talking on a podcast, and I still say Twitter. I just don't even think about it. But what I was gonna say is that if you follow Dylan on Twitter, like, dude, you kill it on Twitter. Like you give so much value in your posts. Like I'll read your tweets or whatever you want to call them now, and you do give a lot of value, man. So I think that's freaking phenomenal. If you want to know some intricacies of RV parks, Dylan, follow him on X for sure.
I appreciate it. Definitely just got active on there a few months ago, but I'm enjoying the conversation so far and learning a lot.
There's like a good real estate community on there. There's like some sarcasm and some assholes on there, but overall it's pretty good.
Yeah, if you can filter that out, there's definitely some gold nuggets.
Yeah, for sure. All right, everyone. Well, thank you for watching the MHP Show. Please like and subscribe on iTunes, Spotify. We're on YouTube. Subscribe to the YouTube channel. We're building that up. We're going to start doing some videos on there weekly and bi-weekly. So we will see you all next week. Peace.